But hello. For those of you who are new to me, my name is Janae of Janaeum.com. I go by the Millennial Money Minister. My official title is Financial Consultant, and I teach people how to manage money so they can make better financial decisions. I was the first person in my family to graduate from college, and so if you're like me and you are the first person in your family to graduate from college, a lot of times you have people who didn't go to college, but they're able to achieve some level of success financially, but they don't necessarily know what to do with their money because they weren't taught. So what I do is I provide the information that your parents didn't show you, school didn't teach you, and banks won't tell you. Hold on for a second, because I wore contacts yesterday, so my eyes tend to water because I have dry eye. So, and it could be really annoying sometimes. Okay. So I understand that fact, and what really impacted me through my own personal journey was being someone who, went to college, got a great job right out of college, but literally outside of budgeting, outside of saving, I didn't know what to do. So if you're someone like me, I was at a point when I graduated from college, I literally had over $10,000 in the bank just sitting there because I didn't know what to do with it. And if you know what the interest rate that banks are offering right now, it's less than 1%. So this was, I graduated from college in 2011. So this was 7 years ago. And so I wish I knew the information that I know now, because I definitely would have done things differently. So that way I could be a lot further than I am right now. I'm still in a good space, but I definitely would have been a lot further had I knew what I know now. And so I wanted to come on and teach that. I did a live earlier today to talk about kind of the basic fundamentals of how you start your journey towards building wealth. It starts with having a budget. So I've been running a promotion or a campaign called Power Hour, where I've literally opened up my calendar to work one-on-one with people if they don't want to do it on their own. So I do have on my website, I have a training called The B Word. And the B Word is a video with downloadable templates to help you literally walk through how to create a budget from scratch. So if you visit, and I linked it in this video, if you visit the training section of my website, you can get the B Word training to get the video where it walks you through how to create your budget from scratch, and all the templates and all that good stuff. But if you need somebody to hold your hand through the process, then that's what the Power Hour session is for. And so I linked the link to that in this video. When you schedule that session, is 60 minutes, and literally I work with you to build your budget from scratch. So we literally go line by line. When you click on the link to schedule the session, you'll be directed to my calendar. After you do that, you will have a form that you need to fill out, where you fill out, what you're spending your money on. And based on that information, I'll use that to build your budget out with you. We'll talk about what your goals are, because I want to see you hit at least one of them within the next 90 days. So if you're ready to get to work, that's definitely the session that you need to be on. Hey, Lori. That's definitely the session you need to be on. If you're going to work with me, you're going to get to work immediately. So if you're somebody who's like, I know I need to do it, but I don't necessarily want to jump right in. I just want to learn what it is I need to do, I just want to learn what it is I need to do, then you need to visit the training section of my website and get the B-word training. It's a do-it-yourself tool, so that way you can work at your own pace. But if you're ready to get right to it, then you need to schedule the Power Hour session, because I don't play no games. So we're talking today about life insurance, how it fits into your financial strategy to help you build wealth. I am a licensed financial professional in the state of Virginia and New York. So I can help you if you do have needs as we go through this training today. And I worked with a client last week, and that's what inspired this video. I worked with a client last week. He's earning 6+ figures. He's in the medical field, and he was interested in learning what vehicle he can place his money in order to help him reach his financial goals. So he did not understand this that I'm going to teach today, and so I wanted to come on and share this because we don't get taught about this. Our parents don't tell us about it. School definitely doesn't teach us about it. And we don't get it from the people who we do give our money to, the bank. So I wanted to come on to teach this so that way you have this understanding. So when it comes to building wealth, so there's 2 ways to do it. We're going to simplify everything. So there's 2 ways to build wealth. Wealth is accumulated and wealth is also inherited. So those are the only 2 ways that you can build wealth. Either you have to inherit it or you have to accumulate it. I was reading Fannie Mae, they posted an article about how there's a income gap or a wealth gap between African Americans and Caucasians after the housing crisis in 2008. And that is attributed to mainly the fact that we weren't, and when I say we, I'm talking about African Americans, and I'm Black American. There's a difference. We as a people did not recover from that housing crisis the way, others were able to. We took a hit, as a result of it. And that's on a wider scale. Obviously, not everybody was impacted by it, but on a wider scale, the article cited that African Americans, they took a hard hit after the housing crisis. So the wealth gap was, African Americans, that put us at a place where we were, wealth-wise, a little over 6 figures, whereas our counterparts, Caucasians, were, in the millions. And so part of that is, having this in place so that way when it comes to building wealth, we don't continue to be left behind. Now, I'm not sure what the other demographics look like, but speaking on behalf of African Americans, Black Americans, I know this is something that, a lot of us don't know, just being completely honest. So that's what I'm here to teach about today. So wealth is built 2 ways. First is accumulated, and second, it's inherited. So accumulated wealth, that is part of what we'll talk about today, but mainly we're going to be talking about how to inherit wealth. And so the easiest way to inherit wealth is through life insurance. Obviously, if you have assets, you can leave that to family members via a will, or what I prefer, which is a living trust, which helps you bypass the whole court probate process. I'm not going to talk about that on this particular video. That can be another one, but that's estate planning. So we're going to talk specifically about inherited wealth and partially accumulated wealth, and how it is incorporated into your financial strategy. So there are 2 types of insurance. You have term insurance and you have permanent insurance. So term is temporary insurance, meaning it lasts for It lasts for a certain amount of time, so either 5, 10, 20, 30 years. And then you have permanent insurance, which is literally a term policy plus cash value. And so there are 4 different types that we'll talk about today. But basically, all insurance, what it boils down to is cost of insurance. So that's how much it costs to insure you based on your age and health. So that's what's factored into what's called your premium, which is what you pay monthly for your policy. So at a basic level, we'll start by how to understand, how much you need and all that great stuff. And again, we're talking about inherited wealth and we're talking about accumulated wealth. So you have term and you have permanent. And I need y'all to talk back to me so that way I know that you can actually see this. So when it comes to, and I have my notes here, when it comes to term, you have different types. You have annual renewable term. And annual renewable term, what that means is that your premium, which you pay monthly, it changes every year. So you might pay $11 a month, every month, but then at the end of the year, it renews, which is why it's called annual renewable term, and you might pay $12 next year because, again, the basis of any insurance is the cost of it. And so as you get older, because you become more of a risk, that's why your cost is always set to increase. Once after annual renewable term, you also have level term. And so that renews on a 5, 10, 20, or 30-year basis. So you pay one price per month, and you either pay it for 5 years, 10 years, 20 years, 30 years. It all depends on whatever policy you have. So I know, a policy that I have, when you pull it out and you read the details of it, it'll tell you there's a cost breakdown. And in the cost breakdown, you'll see the same amount every month for a whole year. And then you'll see the price jump up. Where the price jumps up, that's when your policy expires. And so at that point is when you have to either request that it be renewed or you have to get a brand new policy. So when you request to have it renewed, you will have to go through the process all over again of underwriting with the term because it expires. You don't have any, insurance at that point. You're not insured at that point. And so you want to make sure if you have a term policy that you pull it out, you read it, and you look at the cost breakdown. Where the cost jumps up, that's where it actually terminates. And so you want to know what age that is and what that cost is, because that means that at that point you will no longer be insured. And so you'll have to find another policy to cover you. Now, insurance is basically for people who don't have money, just being honest. For people who have pretty large estates, meaning that they have a lot of money, they don't need insurance. And that's why it is a law for us to have insurance on our vehicles, but the purpose of insurance is to pay for stuff that you can't necessarily afford if something were to happen. And most often, if something were to happen to you, your family wouldn't have any other means to compensate for that money that would be lost because it's not coming in the home anymore. So that's the whole purpose of insurance. And so again, we're talking about the different types because this is something that should be incorporated into your financial strategy. All right, so after level term, you have decreasing. And this is usually what people get when they buy a home. So, like when I first bought my home, I was actually, I say tricked because I didn't know I was buying a life insurance policy. I thought I was getting mortgage insurance, but that's what it's called. It's called mortgage insurance. And basically what it is if something were to happen to me within the time that I own my home and have my mortgage, which is typically 30 years for a lot of people, what that policy does, it basically pays off the house. So that's what it does. I didn't know that. So when the lady came to my house, I guess Virginia Credit Union had given her company or her my information, and she reached out to me. So I'm thinking it's something tied to Virginia Credit Union. I'm thinking it's something that's required. And so, you know, I invite her into my home. We have a conversation. She signs me up for this decrease in term policy. And I'm just like, you know, okay, I have mortgage insurance. And then I learned later that it was actually life insurance, and I was paying way too much for what she offered. So decreasing term is otherwise known as mortgage insurance. A lot of people will get this when they buy a home. And what this does is it covers the cost of that mortgage. So that way if something happens to either of the owners, if you're married or if you're a single person like me, it allows the home to be paid off. So that way my beneficiaries, which is my mom and my niece and nephew, if they do want my house, they can access it free and clear with no mortgage payment. It's basically theirs to do whatever with it if they want to sell it or keep it. So after decreasing, you have return of premium. So return of premium is exactly that. It basically allows you to get coverage, and if you don't use the benefit, you can get some of your money back. I had a return of premium at one point, and basically you pay double because you're literally adding your own money to it. So it kind of gives you a savings account in a way, but the money doesn't actually grow. You're just getting your money back. So those are the different types of term policies, and then we'll talk about in a little bit about permanent life insurance. Okay. So again, going back to the beginning, if you're just tuning in, we're talking about understanding life insurance, how it fits into your financial strategy to help you build wealth. Building wealth happens one of two ways. Actually two different ways. So the first way is through inherited wealth. The second is through accumulated wealth. So with life insurance, it's inherited, but you can also use it to accumulate wealth, and that's more so on the permanent insurance side. And so that's what I'll talk about. But again, if you are just tuning in, what inspired this, I worked with a client last week. He did not know about this, and he was, in a higher income bracket, and didn't understand how he could use this as an option to help increase his portfolio. So I wanted to come on to share this information because I realized that a lot of people, they don't know this stuff. So if this makes sense, and I see people as they're joining, but I want you all to talk back to me because I want to make sure that you actually get this, okay? So when it comes to permanent insurance, you have whole life, which is the kind of traditional permanent insurance policy. You have universal life. You have variable, universal, and you have index, universal. Okay. So those are the 4 different types of permanent policies. So we'll go through each of these. So hello for those of you just joining. If you have any questions, please leave them in the comments. I will answer them. I want to make sure you understand and you get this because a lot of people don't. And for those of you just joining, I have my notes here. And I know this is not a fun topic to talk about. I get it, but at the end of the day, we just have to move past it because you have to understand this. Like, it's not an option for you not to. So life insurance is a great way to build and preserve wealth because, again, it's either inherited or accumulated. And so permanent life insurance allows you to be able to accumulate wealth. So with whole life is the traditional permanent insurance policy. It allows you to have coverage for your entire life. That's why it's called whole life. It also gives you the ability to earn cash value. So term, again, I talked about how the basis of any insurance is its cost. So term is just your cost of insurance. And permanent is cost of insurance plus cash. So they're not too different, except permanent gives you some extra money. So with whole life, again, you have coverage for the duration of your life. And it also allows you to build up cash value. Now, the good thing about whole life is the fact that it provides fixed interest and guaranteed interest. So for the time that you have your policy, it allows you to be able to gain some interest from that particular policy. And that's good because having guaranteed interest is something that's not available in a lot of places. So it's good that you're able to gain some additional funds that way. Now, one of the limitations of whole life is because it does give you a fixed rate in terms of interest, there are limitations there with being able to accumulate a lot of money. But something is better than nothing. So whole life gives you great coverage and guaranteed coverage for your entire life. Now, because of that, it is more costly because, again, we talked about how the basis of insurance is its cost. And so as you get older, the cost increases. And because the cost increases, obviously it gets more expensive, which is why whole life is the most expensive of them all. So as we go down the list, universal life is tied to the market. Yes, it's tied to the market. The premiums are flexible, which means that's the amount that you pay each month. So the premiums are flexible. And because it's tied to the market, you have the potential to realize more gains than you would in a whole life policy because the stock market has great days and the stock market has not so great days. But when the days are great, you can benefit from those increases in your policy. So that interest is credited to you usually at the end of the year, and so you can benefit from that. Variable universal life, it's similar to universal life, except it's tied to a mutual fund like account. So that's also, mutual funds are a form of investment that's tied to the stock market. but it spreads your risk out a little bit, so it helps. But same concept, it's flexible and you can benefit from the upsides in the market. And then lastly, you have Index Universal Life. That's the most recent iteration of permanent life insurance. What that does is it's tied to the actual index, so Standard & Poor's 500. So instead of it being tied directly to the market, which has a higher risk, because it's tied to the index and the performance of that index, you have a greater potential to earn a return on the amount of cash that you have stored up. And the good thing is this has a ceiling and a floor, so if the stock market goes, depending on what type of policy you have, the cap will be how much interest it can potentially earn. So I know for some companies like Transamerica, they have a cap at 13%. Others have a cap like Nationwide at 11%, I believe. So you can earn as much as that per year. And if the index performs negatively, it won't go below 0. So that's the attractive feature with that. So those are the different types of policies that are available. Yeah, I want to make sure you see this. So those are the different policies that are available. I don't see any questions, and I know that people will have questions because, again, this is something that I wasn't taught about growing up, and it wasn't until I went into the financial industry that I learned about this. But again, I know that it's not a fun topic to talk about, but it is important. So why is it important? Because again, building wealth happens two ways. It's either accumulated or inherited. And so life insurance is something that helps to mitigate risk. If something were to happen to you, this allows you to be able to replace your economic value to your family. And so I'll talk about in just a minute how to calculate how much you need. But whether you're getting term insurance because you don't have a lot of money available, at least that gives you something. But if you have more cash, and again, I talked about how my client is using it to help with his investment goals, you can structure your permanent policies in a way that will support whatever savings and investment goals that you have. So again, if you have questions, be sure to post them in the comments. As I shared earlier, I'm also recording this live on YouTube. So I will delete this after I finish and wrap up. And I'll post the YouTube video on my Facebook business page. So if you have questions, make sure you drop them in the comments. But I am going to delete this after I do it. So these are different types of policies. And again, insurance is mainly for people that doesn't have money. Yeah, that doesn't have money, or they want to avoid having to pay out a certain sum of money. There's different things that you can use it for. It has different functions. We won't talk about a lot of that today because that's not where a lot of people are. But it can help you do a lot of different things. One of those, as business owners, for all of my entrepreneurs, if you are someone that has a business that you're not branding and building around you, one of the things you want to think about is the future of your business. And so insurance is one way to help support the longevity of that. because we're not immortal. Something will happen to us at some point. And so it allows us to keep our businesses running in the event that if health were to decline, or if something were to happen suddenly and unexpectedly. We live in a world nowadays where a lot of people are dropping off the scenes at any age, especially with, y'all read the news. So there's a lot of stuff going on where people are, leaving the earth sooner than later. And so one of the ways that I talked about the African American demographic is impacted is the fact that we don't have this. So I'm here to educate you on why we need this and why we need it. So when having the conversation about life insurance and how much you need, there's a method that we use in my industry called the dime method. And this is to help calculate what your insurable need is. So you based it on how much debt you have, your income, over 10 years. So that's basically taking your annual salary and you're multiplying it by 10. You have your mortgage, and then you have education. So this is for people who has kids. The estimate is $15,000 a year for 4 years, or $60,000 per child. So basically, following this method, what it allows you to do, using this method to calculate your insurable need, what it does is it allows you to basically estimate your economic value. So your economic value meaning if something were to happen to you, how much money would be needed to make sure that your family is comfortable. Now, in my case, I'm a single person, so I don't have anyone depending on me, but I do have assets that I would like to pass on to family members, mainly my mom and my niece and nephew. If I outlive my mom, this is what I use to make sure that stuff can be paid off, so that way they can get access to my assets free and clear. Now, debt is pretty much explanatory. You're just calculating how much debt you actually have. So this is credit card debt, student loans, credit card, student loans, any personal loans that you have, all of that is factored into how much debt you have. Then you have income. Income, again, is your annual gross salary times 10. And the reason why we do it times 10 is it allows that income to be replaced over the course of a 10-year time span. So if you have kids who are on the younger end, and something happens to your spouse, what it allows you to do is to replace their income for at least 10 years. Now, of course, you would rather have your loved one with you, but at least if it helps lighten the load, it puts you in a better position financially. Because a lot of times, couples, households, they operate where they're dependent on both parents being available and being able to earn income. And so when one of those incomes goes away, it puts a strain on the other to try to take care of the household. So I recommend for couples to not get used to living off of 2 incomes but 1, in the event that one of you are to lose your job. So with income, you want to base it off of 10 times your income. So that way it allows your family to be able to replace your income for at least 10 years. Now, mortgage is also self-explanatory. That's how much you owe on your home. So if something were to happen to you, your family would be able to pay the home off, and they wouldn't have to worry about who's going to pay a mortgage each month. Especially, I learned about a family who the husband was sick, and unfortunately he passed away, and so the wife was left with the 4 kids, and she was left to basically support them. I don't know what their financial situation was, but I know it's hard enough losing a loved one, especially if that loved one is someone who helps bring income into the household. So by factoring the mortgage into that, that's one of the biggest expenses that we'll pay each month. And so by factoring that into your insurable need, that takes a lot of burden off of the remaining spouse or parent that's left, because that's one less bill that they have to worry about. And then lastly, education. You want to plan for $15,000 a year per child based on 4 years, so that's $60,000 per child. And what that does is, if something were to happen to one of the parents, the money that the remaining spouse or parent would receive would allow that parent to fund and finance their children's college fund and their college education, even though it's just them left over. I didn't mean to say leftover, but you know what I mean. So that's that. So this is called the dime method. Again, if you have questions, make sure that you leave them in the comments. I'd be happy to answer it. Again, insurance is basically for people that don't have a certain amount of assets or income. We'll talk about how much this is how much you need to have. But the 20-10 rule is a quick way to kind of guesstimate how much you need in order to, take care of all of your responsibilities. I really expected to have more questions. I see people coming in and dropping off. So I won't be before you long. I really did expect to have more questions. But I get it's not a fun topic, but it is a topic that needs to be talked about. So I want to make sure that I get this right, and then I will wrap up here. I will be deleting this video after I'm done, but it will be available on YouTube. So the 20-10 rule basically helps you guesstimate how much you need to take care of all of your responsibilities, and then how much you need to have in order to build wealth. So a lot of people don't know how much they need to live off of in order to retire. So the 20-10 rule helps take care of that. So the 20-10 rule basically says that, in order to retire comfortably, you want to plan to have 20 times your annual income. So 20 times your annual income. And to take care of your responsibilities and all that great stuff, and calculate your protection needs, you want to have at least 10 times your income. So that's the 20-10 rule. So if you think about that and multiply your annual income times 20, that's a lot of money. And people, over the course of their lifetime, people barely have 6 figures saved by the time they retire. So usually that 20 number, your annual income times 20, is usually in the millions. So people are unable to save that amount of money during their lifetime. So life insurance is a great way to expedite that, because there are ways where you can put your money away to build yourself up towards that. There are other investment vehicles, and I'll talk about that in later live videos. But in order to get to that million, you have to be investing your money. Now, a lot of people talk about, buying term and investing the difference, and that's fine. You just need to make sure that you are consistent and disciplined to actually invest that money. You need to make sure that you're investing that money in the right places. A lot of people don't, which is why when I work with clients, I help them to actually find a permanent policy that is affordable for them, it fits their budget, and it meets their needs based on this method right here. So I'm going to stop there because I don't see any questions. But again, wealth is, you are able to obtain wealth two ways. It's either inherited or accumulated. And life insurance allows you to not only inherit it if something were to happen, but it also allows you to accumulate it if you are using permanent forms of life insurance. And so this is a vehicle that helps protect kind of everything that you're building. There are some advanced methods that you can implement that I'll talk about on later lives, but at the foundation, you want to make sure that whatever you're building, because it's tied to you, you want to make sure that you're protecting yourself first. So I just want to make sure I did not skip anything. I really hope y'all understood this. I really expected to have more questions. I really, really did. I really did. I want to make sure I didn't skip anything. Okay, so I'll just reiterate again that at a basic level, all insurance, whether temporary or permanent, is based on the actual cost. And with permanent insurance policies, it gives you term or your cost of insurance plus some cash. And then the differences between the different permanent policies is the fact that some allow you to earn more cash than others. And then the risk of how you're able to earn that extra cash is different. Insurance is for people that basically don't have a lot of money. And then the cost of it does go up as you get older because you are more of a risk. So based on however much money you have, term is fine to get you started. And if you have savings and investment goals that are more aggressive, because permanent policies, they're set up to where you can take, well, first of all, the death benefit is tax-free. You can get tax-free, make tax-free loans and withdrawals up to your cost basis. It's a great way to avoid paying additional taxes, which is something that you pay when you have other investment vehicles, because you have to recognize that money as income. So that's one of the attractive features of insurance in helping you to build and accumulate wealth. But as with any financial strategy, you want to make sure that your investments are diversified. But this is definitely a great way to help support you in your journey to building wealth. So with that said, I'm going to wrap this up here. Again, I will be deleting this because I recorded it here on YouTube. So if you have any questions, while the video is still up, if you still see it, you can comment down below. Otherwise, I will add the YouTube video to my Facebook business page. So if you're not connected with me there, make sure you do that. And I posted the link to my YouTube video. So that way you can subscribe to the channel. So that is it. And again, I shared earlier that I'm doing a campaign called Power Hour, basically working with people one-on-one to help hold them accountable towards their financial goals. So if you need one-on-one help and need that extra hand holding, I included the link in this video to get access to my calendar. And if you're somebody who is able to do things on their own, you want to visit the training section of my site to make sure that you take advantage of the B-word training. That allows you to work at your own pace. So thank you all for tuning in, and for those of you catching this on the replay. Again, I am deleting this, but it will be on YouTube. And I already posted the link to the YouTube channel, but I will put the actual YouTube video on my Facebook business page. So thank you all for tuning in, and I'll talk to you next time. Bye-bye.